name is Gary Cullen. I'm a chartered accountant and a chartered tax advisor working here at LBW Chartered Accountants on the Wirral. My role here at LBW is to interpret tax and VAT law and to apply the rules and regulations to our clients in their day-to-day transactions. I particularly enjoy the technical aspects of VAT transactions, having had a pretty good grounding in my time working with Grant Thornton in Liverpool. VAT on buildings can be quite a complex part of VAT law because the transaction itself can either be standard rated, zero rated, reduced rated, exempt, or outside the scope of VAT. The sale of a commercial building can often depend on the use of that building. If a building has, for example, been opted to tax, then any transactions relating to that building being rented or on any subsequent sale will involve VAT being charged. The purchaser of the building will then be in a position where they will necessarily need to recover that input VAT. If they are carrying out a trading activity from the building, then clearly they can recover that VAT, providing they are themselves registered for VAT and making taxable supplies. If, however, the purchaser intends to let the property, then they themselves will need to opt to tax on the building so that they can recover the input VAT they have been charged. But they must then realise that every supply they make in connection with that building, be it either rented to a third-party tenant or indeed subsequently sold, will have VAT attached, and thus they could limit the number of potential tenants they could have in terms of non-VAT registered businesses or businesses which are unable to register for VAT because of the nature of their supplies, where they would effectively be putting them out of the market. There may well be occasions when the building itself is a business. For example, a property which has been opted to tax and has been let to tenants. If that building is sold and certain conditions apply insofar as the purchaser of the building themselves registers for VAT, then the transfer of that property could well be regarded as outside the scope of VAT. The advantage that necessarily has is that stamp duty land tax is paid on the VAT inclusive of value of the property, and therefore if there is no VAT attached, then there's a potential reduction in the stamp duty land tax. If, however, the property is neither a business in itself nor has been opted to tax, then any subsequent sale of that property will be an exempt supply. The purchaser has the opportunity on the acquisition of the building to then opt the building to tax for their own purposes, insofar as they will be able to reclaim any input VAT on property repairs, as an example, but they then must have consideration for the fact that every future supply they make from the property will in fact be subject to tax, be it either rent or subsequent sale. One final point to consider with commercial property is the conversion of commercial property into residential property. Construction services supplied in the conversion of the property can benefit from a reduced rate of VAT, currently at 5%. This will only apply to construction services, which can include materials provided they are supplied along with the construction services. The actual purchase of materials itself will not benefit from the 5% reduced rating. The same reduced rate and conditions can also apply to the conversion of a residential property, insofar as we would be looking at a circumstance where we've got a single occupancy property which is converted into multiple occupancy. Whilst on the question of residential properties, the disposal of most residential properties will be exempt from VAT, which is why a homeowner, when they sell their property, although they are making a supply, they are making an exempt supply and are thus not required to register for VAT. All new build properties can be sold with a zero rating on VAT. This is not the same as an exempt supply, it is a zero rating. The supply of services from subcontractors working on new build properties can also be zero rated. They will quite clearly identify that they are working on a new build property, and therefore they will be eligible to supply their services at zero rating. But by the same token, if the developer themselves acquires materials from the local builders merchant, that builders merchant will have no proof that the work is being carried out on a new build property, and therefore they will charge VAT on the supply of materials only. Therefore, it is up to the developer to be registered for VAT to reclaim the VAT thus incurred. One further point regarding a new build property is that if an individual wishes to build their own property, then they can recover the VAT they incur on the materials that they buy by using the DIY house builder scheme. Clearly, any subcontractors that they employ can likewise see that the work on the property is in a new build, and therefore they will be able to charge zero rating VAT on the supplies they make to the house builder, and the house builder can reclaim the VAT back that he does incur from HM Revenue and Customs. There are certain exceptions included in the items for recovery, normally items which you wouldn't normally find in a home. And quite clearly I've talked about quite a number of matters relating to the property and the various rates of VAT that can apply. It is an area which does require careful planning, because whilst I've given a brief outline of the various rates that would apply, there are always exceptions to the general rule, and careful review of the legislation would be required for each individual circumstance. Hopefully you have found this brief review of the VAT aspects of land and buildings useful, and we do have quite a number of other technical tips and advice on our YouTube videos.